Good morning, traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Wednesday, August 8th. Mike Boutros here with you this morning. JR, Mark, Peter, Pete, and Pete all in the room. Tom, Ty, Ziad, great to see you guys this morning. And the lull continues, right? Things are kind of still stuck in a range. We've been getting some plays here and there. Dollar yen finally worked. We got a limit hit on the bottom there on that decline. Dollar CAD still moving higher. Aussie still in the consolidation range. We'll hit all of those today. First thing I did want to cover is really quick is the New Zealand dollar. As I noted yesterday, it's not a very clean setup, but the RBNZ is on tap tonight. So we want to be mindful of the levels of importance, specifically for Kiwi, which is sitting at support. So we'll hit Kiwi dollar, we'll review Aussie, again, dollar CAD and dollar yen from last night. We'll circle back to the sterling and Aussie crosses that we've been following. So sterling dollar, sterling Aussie, euro Aussie, which is still holding that support. Pound Aussie broke support, so that one's still in free fall. And then the update from Sunday will cover DXY and euro dollar. Just as a quick side note, as far as the risk markets are concerned, who was asking yesterday? Peter, was that you about the S&P 500? I just wanted to highlight that level of resistance. Here's the daily chart we've been following, held into the close yesterday. So Peter says, yes, it was me. All right, so yeah, 2860, man. It's, yesterday we closed at 2860. I'm sorry, we closed at 2859, okay, right here. The 1618 extension of the ascent off the lows from May, coming at 2860. The high day close for the year is 2851. So we're right there. Interesting area to watch today as we start the U.S. equity markets. But just wanted to highlight again that level has been of great importance. We've been watching it for a while, and here it is in play. So watch for some sort of reaction off that. Weakest performer to start things off on the session, guys, is the British pound, down 0.56% on the session. Loonie is the second worst performer, down 0.2%. That's dollar CAD higher. Japanese yen was the highest performer. It's only up versus the dollar down 0.29%, but it was down much deeper earlier. So getting a little bit of a rebound here. Let's get started. Any other questions or trade setups? As always, guys, feel free to throw them on the message board. So here's Kiwi, and here's what we looked like last night. Just wanted to highlight the major levels as we get into these interest rate decisions. Things can get kind of funky. You did see that Aussie, although we got as expected the move, saw a nice little hike there, right, on some hawkish commentary that went to the top end of the range, is coming off here soon. But here's Kiwi rather on the weekly charts. Okay, the key support region is 67.17 into 66.60. I know it's a big range. You're talking about 60 pips almost as far as a key support range, but it's held the yearly low stretch. It's the 100% extension from the decline off the highs he made last year and this year. It's the 618 retracement from the ascent off the lows in 2015. So look, it's a huge pivot in price. Okay, any way you slice it. So as we get into the release, the emphasis for the bears is to push below and close below 66.60. That would really open up, a much deeper decline in Kiwi. That being said, I can't sell into support, right? So our base case scenario is actually to look for a possible exhaustion move at one of these regions. Here's the daily chart, and here's what the daily chart looks like now. Okay, so you're essentially looking at that 618 retracement, that 100% extension, near-term slope. So this is just off of those highs. It gives you a parallel right there, caught the low for the year so far. That converges, okay, on that 100% extension at 66.60. The 618 is right there, near-term support at 67.15. So the possible scenarios, right? If you were to get some sort of steep sell-off in the Kiwi, but a quick recovery, so a reaction off of a drop into this zone, might be a reaction like this that we could fade for a near-term play to the upside. With the same respect, if it rallies, we'd look for failure again at 68. Barring any kind of major announcement, there's really nothing I think that'll come out tonight that'll necessarily shift things as far as monetary policy is concerned out of the RBNZ. But That's major resistance. And again, that's the emphasis for the breakout. Okay, not only are we looking at this parallel here, perfect resistance, pivot, perfect support, a little bit of a drive into there, but pivot, break, acceleration, resistance, resistance, resistance again. This is also, my friends, the monthly open comes in at 68.17. Okay, so this is the level that we need to break if Kiwi's going to rebound. Okay, the play is if we get a drive lower to look for exhaustion down here. If we break sub 66.60, sayonara. This lower parallel hasn't really been in play. I mean, you could get a bid there somewhere near 66, but at the end of the day, you're really at risk for a steeper decline if you break that 66.60 barrier. So some key levels to keep in mind for Kiwi as you head into the release. Here's what the near-term picture looks like on the 240-minute chart. Here's what it looked like last night. Again, this consolidation region, not too dissimilar from what we were looking at in Aussie dollar, continues to highlight that the initial July opening range remains intact. So at the end of the day, this is the second month now maintaining that initial opening range in a contractionary pattern. So if we get the downside break, again, be mindful of 67.57, 67.15, this nice near-term confluence here. This is just 100% extension from within the triangle. Okay, so that's the breakout that really would unleash that last leg near 66.60. And again, this is kind of where if we're gonna get a bounce, if Kiwi's gonna hold, that would be the level to be mindful of. That was the level that we were looking at here during the sell-off in early July when this thing was in free fall. We just turned ahead of it, right? The low there was 66.86. So maybe triangle consolidation break gives you that last drive lower. So at the end of the day, bottom line, guys, the risk is lower right now. But if this is going to be sort of a fake out play, it'd be one of these two levels. I'd be looking to catch a bid. Okay. Again, not a trade that you just want to put a limit order entry here and hope for the best. We really need to see what the remarks that we're going to get from the RBNZ reveal. Remember, these interest rate decisions are not as easy as an NFP print or a CPI print where it's the data better than expected, worse or better. This is, it's all about the commentary and the market's perception of how that commentary is going to shift monetary policy moving forward. So at the end of the day, the risk is lower, but I wouldn't get too excited. If you're looking to play the downside here or you're interested in scalping the short side, that's fine against the weekly opening range highs. Basically against Friday's high, any stop that you take on the short side needs to be against that high. But really play it tight. I mean, if we get a strict washout near 66.60, again, I'm going to be really looking with intent to see if we get some sort of rebound. We went over yesterday the implications of the triangle break, right? If the triangle, I don't even like calling it a triangle, but if this triangle or consolidation level does break, the measured downside move is much deeper. Okay, we'll cross that bridge when we get there, but that's sort of the game plan for Kiwi dollar moving forward. As I said, it's not a favorite setup. I haven't been involved in Kiwi really for a couple of weeks, but I think it was prudent to bring these levels up as we head into this release. Any questions on New Zealand dollar? RBNZ interest rate decisions later tonight. Again, they're expected to hold interest rates steady at 1.75%. All right, that is Kiwi dollar, number one. Number two, Aussie. Not too different of a setup, although Aussie was, as I noted yesterday, trading towards the upper bounds of that recent consolidation range that we've been talking about. Do you remember in the webinar yesterday, guys? It was ironic. We just tacked on that 100% extension as market was stretching into it, literally. We put it together here in the webinar. That ended up catching the high into the U.S. trade session. It held a pullback. Had me looking yesterday for 74.12 and 73.97, basically 74 handle for near-term exhaustion. Okay, if we're going to pull back, if the move still had a move higher to go, these are the levels that you'd be looking for. At the end of the day, as noted, you're at the top of the consolidation range. So inherently, you don't want to be fading out of long positions. You want to be looking for a pullback. Ultimately, like I said, I would love to see this consolidation resolve to the upside, but until it resolves, consolidation is the name of the game. And here we are moving lower. So the weekly open support is not holding here. If we drift lower, if this continues into the US Open, you'd expect to see some further pullback. There's no play here, guys, per se. If you're not already in on the pullback to play the short side, the play was on that secondary rally yesterday against the highs, just to get the move into these two levels. From here, it's consolidation, guys. Okay, the risk is lower. I don't suspect you'll get all the way down to 73.27 again. So, kind of have to let this one go for now. Right slap in the middle of the weekly open range as well. Here's your weekly opening range low. Here's your weekly opening range high. So I don't really know how to get involved in an Aussie position from here. You'd need to either see a move back towards range lows, or if we get that move back towards 74.30s, an entry there might be another move for continued consolidation. But this thing is just coiling. It's just coiling. The seller doldrums are upon us. So this lull, we get weak market participation. We have to be patient. It sucks, and sometimes it's just really boring, but we have to take what the market gives us. Okay. Near term on this, I was scoping this out earlier today, just before the webinar. Oh, the 1618 already gave out. That's what I was thinking of. All right. 50 comes in here for the spread off of last Friday's advance. 618 comes in at 73.83. Levels to be watching today into the US trade session. Weekly opening range low comes in lower. I wouldn't even wait for that break. If it gets below 73.80, just forget the upside. It's probably going to go to range consolidation lows. Any questions on Aussie? Again, here's the bigger picture. Remember, your key range on the Aussie dollar weekly charts, 75 is resistance, 73.27 is support. We're still looking for a break of this range, which has held since late June. The coil is going to give out at some point. Just got to be patient. Questions on Aussie? Okay, dollar CAD. You do have some dollar CAD data at the end of the week. So you get CPI data from the United States and CAD employment data on Friday, 8:30 Eastern. Likely to see that move and shift this pair a good deal. Here's what dollar CAD looks like now. So that advance continued. We broke through 30.66. Recall that was the level that we were talking about on the Sunday update. Also our near-term bearish inval. So again, we're looking for that stretch near 31. The upper parallel is just higher, 31.20. 618's at 31.30. So this is the sort of the region that we're looking for as resistance in dollar CAD right now. Here's the chart looks like on the 120 minute, and here's what it looked like last night. So recall again, the previous update on dollar CAD, we were looking at this range, looking for support either on a drill down into this region or the convergence down here at 29.50. So you had 29.67, 29.57, this region right here. Again, top side levels were well marked. So we started the week, we came off the parallel, slammed into that support level. It held, launching point. Here's that first target, breaking higher. Again, 31.02, 31.03. That upper parallel, 618, basically gives you 31.20, 31.31. So, all things held constant, this thing has just been pretty clean. Can't really complain. Levels are pretty clean. You look for the larger recovery here. Again, with that data on Friday, it's going to be interesting to see if this can maintain this sell-off in the CAD, right? Obviously, this is CAD weakness, dollar CAD to the upside. So, yeah, I still think you get in your 31.20s, 31.30s. Look for exhaustion into that region. But Pretty big reversal, guys. Yesterday we made an outside daily candle. It wasn't a reversal candle, but it was an outside daily candle that took out into key support. Again, 2967. 100-day moving average was also in that same exact region. It's the reason we were looking for that being sort of a critical support region. There's the rebound. This is your first major key level of resistance and a huge pivot in price. Look at the daily chart. Just look at that. Break, acceleration, resistance, break, acceleration. Dribbled a little lower here, but support, support, break, acceleration. Here we are testing it as resistance. Watch 3120 into 3130. Obviously, also momentum isn't overbought in the intraday chart here, so not something to fight. If you're holding long exposure, I would just be bringing stops up into break even or better at this point. You know, it's worth taking a little off the table just above 31 as we are now into this region, but watch for a break here. If this breaks, I'd expect to see acceleration. As it stands right now into the US trade session, I'd be looking for a near-term exhaustion high into this region. Questions, comments, concerns on dollar CAD? Next, I can't believe I'm saying this, has been my favorite setup so far for the week. Ugh, gotta wash my mouth out. Dollar yen. Um, so we bailed on it on the swing trades. You saw yesterday, guys. You guys actually are the ones who alerted me that Jamie put our stop to break even on the swing. So unfortunately, got that taken out. As I said in yesterday's piece, I hung on to a piece of it. I guess sometimes better being lucky than skillful. On this drive higher, you know, my stop. So we took a little off the table yesterday in the webinar. Remember, I told you if it got back above 1121, I'd get skittish out of this. So as it got into 1120 and started pushing higher, I took off a half of the trade. It was a 35 pip profit, and then I put my stop just above that swing high. Luckily, we just missed it. As we started to break down last night, I went break even, and the limit was at 110.90. It was just above this region. So I'm out of dollar yen. It did make a nice bounce off support. So remember, at this point, it's Wednesday. You've essentially made a weekly opening range stretch into support. Look for the break. You do need to adjust this retracement to account for the new low that we made last night. That brings down your near-term resistance to 111.50, and bearish invalidation gets lowered to 111.65. Okay. I still think you get the downside break. Here's dollar yen on the weekly, guys. So it's been all about 110.88. That's sort of the level to beat. That's the 618 retracement of the decline from the highs that you made in November of last year. You have slope here off the 2012 lows, right, in red. Right there, break. It's been pivoting all around. It's right there as well. It's kind of a huge congestion region, catching former swing lows, former swing highs, former swing lows, former swing highs. We're right there. You know what I mean? So where we reversed off of was magnificent. 113.27 had the 200 long week moving average, as well as the key 618 retracement from the decline off the highs in 2017. So that was a beautiful reversal. This is support. So yeah, we've been favoring the downside, but like, you know what I mean? I've just been booking everything ahead of 110.88 because that's the level we need to see break. Just below that, you have the 52-week moving average, so 110.15, watch it. But basically, this is sort of the level we need to get, you know, basically for resumption of the downtrend. And interestingly enough, guys, here's the yearly open. Here's your yearly opening range highs. Aside from the fact that you had all that technical considerations there, it was the objective yearly high. We just made a full V round trip, failed, and again, we're sitting at support. So dollar yen quickly goes from being our favorite trade to sort of what the heck do you do now, right? Here's what it looks like on the daily chart. Again, highlighting 110.88, former swing lows from November of last year, 618 retracement of that same drop. The 50 line for the current operative structure we've been working off of from the lows. You know what I mean? It's just not worth it. It's just not worth it to sit in a short waiting for that to break. So It could gather some steam here. You know, you could see a little bit of a rebound. I'm not playing the long side of dollar yen. I really just want to see how it reacts off this level. If we start to get failure again ahead of the median line, might be another entry to get back in. If we break back below the favored move, you'd look for a recovery and try to get short again as close as you can to that level for the stretch lower. Subsequent daily target on the downside, if it breaks, is 109.91. Okay, that is the 200-day moving average, and that converges on a basic 38.2 measured move of the yearly range, right? So all of that converges on basic slope support. So it's all on this guy. I really can't convey to you how important 110.88 is. If you know, we talked about it last month on the decline. That was the level we wanted to see break. We probed below it multiple times on a break, or on a close level rather. We did not and have not been able to close below it. Look at that. So long story short, watch 110.88. You know, what do you do when a trade comes off resistance into support? Well, you look to see how this reaction pans out. The emphasis is for the bears is on a break lower. Well, moving averages are shown. TIE on the daily chart, you're looking at the 200-day in green and the 100-day in blue. Okay, on my daily charts. TIE on the weekly charts, you're looking at the 52-week, okay, and the 200 long week. So this is the moving averages I'm usually working with on the weekly charts and the daily charts. Make sense? All right. So say the weekly again. The weekly is the 200 week and the 52 week. 52 weeks. So it's a yearly moving average and your 200 week moving average. All right, so watch 110.88. Let's see what dollar yen gives us. We're pretty clear on data. Core machine orders later tonight. GDP on the 9th, so that is tomorrow. We do get, excuse me, Japanese GDP for the second quarter, preliminary read, quarter on quarter expected to come in at 1.4%. All right, let's move right on. So that is dollar yen number 4. Out of those shorts, we need to see some sort of inflection point here off 110.88. Next up is pound. Like I said, worst performer today, getting hammered, but boy, are we in a contentious area. So Jamie noted 128.99. I gave you guys 128.77 for the last couple of days. Those are two levels that we were looking for possible exhaustion for this sterling sell-off. Look, on the weekly charts, at basic 618 retracement, your lower median line parallel, right there. We need to see the close, okay? Intra-week, I'm not gonna pay too much attention. It's all about whether this line chart closes above or below 128.77. Major key retracement, slope support, momentum at support, okay? Just as objective as possible. Sterling on the daily chart looks like this. There's that slope region we talked about yesterday, the lower median line parallel. Again, if you take a parallel from the slope or from the stretch lows, this region has caught every single low this year. Once, twice, thrice, 4 times. What's going to happen here? I'll tell you what, I definitely don't want to be jumping into a short from this level. It's blind. There's nowhere to put a stop. At the same time, am I going to buy right here with no conviction that this is going to hold? I have no freaking clue. No, that's not my, you know, I don't play, I'm not betting when I'm trading, right? We're making, you know, proper statistically sound, you know, approaches to the market. So we have to wait and watch here. Again, I'm of the mindset that you do get a fake out exhaustion low. Be mindful of a couple of things though. You have a support trigger that has given out in daily momentum. That's bearish, okay? That gave out a day or so ago. We're now testing 30 on the downside as far as the momentum profile is concerned. Support is testing, or price is testing support. You know, these are the areas where you want to be very mindful. This, a lot of people aren't even looking at this slope. okay? And they're just getting on the bandwagon and getting really excessively excited, in my opinion, for this sterling sell-off. Now, look, we have to stay objective. We have to stay disciplined. If we close below this parallel series or this parallel zone, break of support is a break of support. We have a break into oversold territory at that point. You're looking for 27.75. You're looking for 26. You're looking for 24.60, believe it or not, on a real break of this downside. Remember, a break of a descending pattern, typically those are the sharpest parts of the decline. Just like when you get a breach of an ascending pattern, that's typically the sharpest part of the rally. So the risk, if you see here, this break lower is for a real acceleration to the downside for sterling. So something to be mindful of. You know, I'm looking to see if we can get a hold here. I'm looking for an exhaustion. Here's what the intraday chart looks like. It's real precarious here. Here's the 240. It's real precarious here. Okay, there's that support zone. Every single low this year has been governed by this region, right? So the levels are clear on sterling, but we have to be mindful of chasing this any lower. Give me 1 sec, guys. I just want to see where trader positioning looks like on this. Okay, net long positioning is 2% lower than yesterday and 24% higher from last week. Net shorts are 8% higher. So you are getting a little bit of a build in net shorts. So the net long position, it's at 2.45 as far as the ratio is concerned. This is client positioning, IG client positioning, guys. So it's telling you what retail is doing. Retail is net long. That's not a bullish signal. However, the net long position is starting to come back from extremes. That is a bullish signal. So remember, they're going to be most bullish at the lows, right? So as markets or as retail starts to pull back from extreme net long positioning, that's actually when the market starts to turn higher, typically in price. So there's nothing that's written in stone. These are all just indication and little tidbits, right, of evidence. I'm looking for an exhaustion low while above this parallel. Bottom line. Bottom line. We'll keep you updated. You know, if there's a move from a swing side of things, but from the intraday, I'm gonna be looking at this with great intent into the U.S. Open. Real tight stop against that slope low. If you do get in, your first bit, your first major objective target is gonna be just the former swing lows for the July decline right here. So basically 29.56. Weekly open converges or comes in just above that 50 line. So that would be the breakout and sort of the suggestion, if you will, that there is a near-term low in place. All right. Any questions on sterling? This is a high risk, guys, trade, but it's make or break period here. This is, all the eggs in the basket right here. It's number 5, sterling dollar. So on the sterling sell-off, no surprise, on the Aussie rally, we've been following that one, right? Pound Oz went into oblivion on the way down. Intraday levels, interestingly enough, have been pretty spot on. Here's the daily chart that we've been following. Obviously, the break of the consolidation pattern that we were looking at all into the close of last month, into the start of this month, rebound off of the slope resistance on an outside reversal day, took us lower. The big levels that we were talking about were 74.70 and 73.93, basically 74, right? So that's the swing lows that we made from June of this year. So, we probed into it. We drove a little lower. We had a former swing low here on the intraday chart that we noted from back in January. Here's what it looked like on the intraday. You could see that we dropped the pin bar right into that, and nice hold there. So look, if we close the day above this, yeah, respect the near-term recovery. Nothing to be like, that's not a radical idea. It's been a 4 or 5 day, today would be the fifth day, of straight declines, just off of the monthly highs. And mind you that we're only in the eighth of the month, we're already down 2.4%. So, if we close above those lows, I would expect to see some sort of near-term recovery. Not interested necessarily in playing the recovery. I do think the break of the larger pattern we've been following here does warrant further losses for pound Oz, but just a quick, note here not to chase this any lower from here at this point. You would need some sort of recovery before you try to attack this again on the short side. The other one that we were covering as far as the Aussie crosses, that was number 6. Number 7 was Euro Aussie. That one is holding support. So similar in that we had this near-term consolidation. Aussie, or Euro Aussie rather, was a flat, just range-bound market that was sitting there for weeks and weeks and weeks. There was the break. We highlighted 2 levels again here of note on the downside. The first one being 56.22, the 2017 high day reversal close. And the 50% retracement at 55.83. We held there for a day. Yesterday, we got another drop. It came right into that 50, and here's the rebound. Cautious on the way up. Not really looking for too much on the advance here, but note that it is a pretty decent slope. This is just a parallel of the same slope off the highs, right? Really nice rebound here. So I do think you can get a little bit more upside to go, but I don't want to get too aggressive on this one either. Here's what it looks like on the intraday chart. This is the 618 line or the 775? 618 line of the range, pitchfork. This is from the high on July 2nd, the low on July 18th, and the subsequent high on the 19th. Just really clean, right? There's that 618 line, convergence to the 50% retracement, boom, rebound. We highlighted resistance yesterday in the webinar at 156.54. We held there. Here's the break. So basically, you're still looking for a drift higher, maybe 56.98, that 618 line. But you would want to start to fade out of any long positioning, look to fade or get into short positioning towards those upper parallels in Euro Aussie. Here's the 120-minute chart. Okay, so sort of something like this, maybe this, but I wouldn't be looking to test it any further beyond that. And actually might be a decent positioning for the short side again. So Euro Oz, another interesting break, finally, of a multi-month or multi-week range in this case. But certainly we have to respect that near-term support that we're coming off of. So both pound Oz and Euro Oz, right? Really nice breakdowns coming into some initial support. So curb expectations to the downside on both of those. Interesting, both of those, some crosses, some non-dollar crosses that we've been involved in that haven't, that actually have been on the move, I want to say, where we've been waiting for Euro and Aussie and dollar yen and to finally clear these godforsaken ranges. These crosses have actually been pretty decent play. Here's pound yen, by the way. I didn't plan on talking about this, but I was just looking at this ahead of the webinar. The only thing I wanted to highlight here, looking for support, right? You start to look for these themes. So we talk about sterling dollar coming into a major area of support. We talk about sterling Aussie. It probed below daily support, but certainly the daily close is what's going to determine that. Here's pound yen, okay? A little bit further down to go before you start to head into structural support, but I do think that you're mindful heading into like 42.50s. Again, clear trigger break. The move has been pretty direct, pretty clear cut and simple. I'm looking for possible support down there in pound yen as well near term. So a look at the pound crosses and Aussie crosses. Any questions on either of those? All right. DXY and Euro. Oh, the DXY, this thing. I mean, there's really nothing new to say here, guys. All the dollar crosses just have been so frustrating. If you're not playing the ranges, it's not worth playing. because you get into a trade, you're trying to play the breakout. Markets just aren't prepped for the breakout. There's low participation. Moves all quickly fade. So you have to be nimble. You have to be in and out. You can't. I just don't think it's proper time necessarily to be positioning for the larger moves. We will get these breakouts and all these coils. Bet you, um, it's a sure bet that they will break and there will be a sudden surge in volatility, which is going to catch everyone on the wrong foot. But until that happens, we kind of need to be, patient. I'm going to highlight the same stuff I've been talking about here for weeks, guys. I hope it's not boring. You got to watch the 200 long week moving average in DXY. It's been the level to fade. You know what I mean? This is what the eighth. 1, 2, 3, 4. This is the eighth attempt, okay, to push through this on an eighth week basis, unable to make any closes where near that moving average. So, I mean, look at momentum. It's just been, the pullbacks have been short-lived, but it's been unable to do anything on the upside here. So look, weekly close above this is still needed to get 96. If it happens intra-week and we start to push higher, that is your target on the upside, is 96. On the daily chart, here's DXY. Once again, still holding below that former support trigger and momentum, still holding below those, former swing highs for the year. You're talking about 95.50, you're talking about 95.65. It's just, it has no staying power on the downside. It's really, super frustrating. So we're in the range until we're not. Here's the intraday chart. Nothing really interesting to look for here. Didn't quite get the extension to a basic 38.2 retracement that we were looking for early in the week. The lows fizzled out right at 95. We were looking for 94.97. And here we are just sitting right within the initial weekly opening range. What do you do? What do you do? Now, for Euro, the saving grace is the longer term picture here. Here's Euro on the daily chart. And here's what we look like in Euro. Sterling levels, by the way, unchanged. Sterling Aussie levels unchanged. Euro Aussie levels unchanged. DXY unchanged. Euro. So here's what we look like earlier in the week, right? We talked about this being a key support zone, 1605. We closed below it last week. The risk is lower below that. You're looking for a possible drop into 1450 if we hold below 1605. So to start the week, that's sort of the level we need to see break to get this thing going. You have a momentum trigger here in weekly momentum, which is pending, okay? Daily chart looks like this. There's that key support zone on the daily basis, 1554, 1565, 1556, excuse me. 20 pip region has caught all the lows so far this year. Look at this. Look what we did. Look what we did on Monday. Boom, right into that region. Rebound. Look where the rebound found resistance. 3-point resistance, 3-point support rather. Break accelerated. There's resistance. So your whole focus right now is on a break of this range. The highs that we made so far in overnight trade, which came at slope resistance, former slope support, and the key support barrier at 1554, 1530, right? This region here. So support, the break to the downside, again, 1448 is your initial target, that nothing changes there. If we break the weekly high that we just made, those former lows from last month that we made towards the end of the month, you look for a stretch into monthly open resistance, the upper parallel, that takes you all the way up into like 1690s. So another scenario where like if the near-term range is what's needed to break the focus on a play, here's why it looked really interesting to me. It looks like a 1, 2, 3, 4, 5. I wanted to see this break above the low day close, 1603, hold it as support. Obviously, we're sinking back below. But if this turns out to be like a 3-wave correction pattern, basically you want a 618 hold. You know what I mean? You want to hold above 1567. So maybe a little swing higher, then another draw lower, but I want to see this region hold. That's also the objective weekly open. Okay, there's your weekly open, literally right there at 1567. So That's like where it would need to hold near term if this is going to vault higher. If it starts to break down beyond this, guys, again, we're fighting a losing trade. It's a break of support on the longer term picture. 1530 is going to be the level again that we bottomed out on Monday. That's the 2016 high close. That's the level that we've been watching. Chiratamo below that, you know. So again, we need to see a near term break of this key range in euro to get the guidance here. Questions on euro dollar. You're getting some data hitting the headlines this morning, guys, that China is imposing more tariffs to match the ones that the new administration has kind of like recently pushed on. This is going to be an ongoing story. You know, whether it takes market attention or not, I just don't want you guys to get fooled by all the headlines, because if you follow the headlines, you think that the world is falling, right? S&P's at record highs. I mean, I don't understand what everyone's looking at. Obviously, the market is just not paying, I don't want to say paying attention, but it's just not seeing that as a real and hardened threat to the market right now. So watch price, man. Just forget all this news. That being said, 2860 is resistance. We talked about it yesterday. That's the level we're looking at. Plain and simple on the SPX. Okay, plain and simple. And that was 11. Okay. Any other questions, guys? I'm wrapping up early here today. That's pretty much all I got. Like I said, I've been a little trigger shy, a little bit on the Aussie. Kind of was chasing that a little bit, so I got pretty quick out. But dollar yen was the only really kind of strong positioning that we've had this week. We're still looking for some clarity on these range breaks, and I know it can get frustrating, but part of our job, guys, is not only to point out where the opportunities are, but kind of point out where you want to take a sidestep and where it's just not feasible to really get aggressive on the markets. And I think we're in that position, unfortunately, right now. These time periods don't, again, will end. They don't last forever, and when they do, usually ends with a nice bang. So patience pays. Again, we still do have some major U.S. data on tap later in the week with those CPI numbers. Going to get a nice update on inflation. Again, we get GDP numbers from the UK. Tomorrow, we have some data coming out from Japan. So keep that in mind. A quick look at the commodity block before we close things out, guys. Crude oil, just wanted to highlight the reversal that we're seeing is still pretty much in line with the expectations that we've been talking about for one more low in price before this thing starts to find any meaningful support. Here's the weekly chart. Nothing really new to talk about there. It's the daily chart that's interesting for me because, well, let me just show you what we're looking at. So the former 2010 swing lows, we talked about that all the way back here. Okay, that's 67.14. That's basically where we grounded out. The 786 retracement of the near-term advance is 66. Then you have this confluence region here of the 618 of the yearly range. This is your 2017 low, and that converges on the 200-day moving average, or will, over the next couple of days. So I do think you get a drive lower. I don't know if you get sub 66. Just know these two levels, okay? 67.14 and 66. For me, that's sort of the attention right now for crude prices. Okay, here's what the intraday picture looks like. Pretty weak. Many systems and traders are killed in August. Yeah, Ty, because what happens, again, the market lulls, the doldrums you call it, right? And a lot of traders are very, let me take a step back. Ty, the biggest problem that people run into is that, or retail run into, and this is just from working for different brokers, they fall in love with a specific trading strategy, but they don't adapt, right? So markets go into trending environments where markets are clearly trending. You want to be, singularly just fading a one directional move. And then markets come into this lull where they start to fall into range bound. Retail traders inherently lack the ability to kind of shift their way of trading, right? They fall into a way of trading. That's the way they trade, and they kind of just get stuck. Different market conditions require us to change our approach, right? So yeah, systems which are mindless, key entry, if that while they were, I hit mute by the way, that wasn't a freeze. While they work great in trending markets, those systems need to be straight up shut off. You need to turn on those near-term momentum trading systems for range-bound markets, and that typically is not a easy move for retail trader to make. They kind of get stuck in one. Um, they kind of get stuck in one form of, that's the way they trade, and they don't adapt to the market conditions. We adapt, right? If we're trading with a specific strategy and the market conditions are changing, I can't sit there and continue to wait for a 300 pip move with a 75 pip loss, because that's my favored win loss ratio. When the market's giving us a 30 pip daily ATR, it just doesn't make sense. I don't understand it. But again and again, retail will fall into this into this um, same doldrum. Ty says, in 30 years, I can't count the August bloodbaths as signal fails. The reason I love SB allows us to change our approach. Cheers, Ty. And that's really, man, I appreciate that. That's really our goal, is really kind of steer you in the right direction, is the way we trade. We see it as we're all doing it together. Um, so we share in your losses, we share in your gains, and that's kind of our point here, is to build a community where we're really just keeping our eye on the pulse of the market. To hell with the noise, to hell with the headlines and all the talking heads online. That's just, it's entertainment. It's not investing or trading. So price action has been our guide. Price action will be our guide, and let the market do the rest. So I appreciate that, Ty. And last but not least, gold. Okay, this is another one where, man, this range, when it breaks, oh, it's going to give us something. I posted this chart yesterday on Daily FX as well. You guys know the levels really well. The daily chart's pretty much all you need. Look at this. If you ever question the validity of technical analysis, sometimes especially when the markets start to do their own thing, you start to think, what the hell is happening here? Look at this, right? You can't make this stuff up. Here's median line. Obviously we've had a couple of inflections where it hasn't been as clean, but look at the last 5 days. Resistance, 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 resistance. 1215, 1214 now is a key range as the former swing lows from back here in May of last year. 618 retracement of the advance from 2016. Median line. All converge at 1214, 1215 on a closed basis. Boom. Look at that. So that's the level to beat. A 1215 break changes things objectively. You have a multi-month, this is basically since the start of the year. It's not basically, it is since the start of the year, a resistance trigger in momentum. We've been marking crazy divergence into the lows, price action with a lower low, price action with a lower low, oscillator with a higher low, Consolidation in momentum, consolidation in price. This thing's gonna pop. Now, whether it's coiling for a major low, says Ty. So conventional wisdom would call these triangle consolidation patterns, Ty, what's the word? Resumption patterns. Okay. They're typically not terminal very often. I have seen cases where they are terminal. I think I talked about this yesterday. Terminal meaning it ends the trend or it reverses the trend, right? So the conventional wisdom, at least in my mind, would be, yeah, that this thing would stab to the downside, fake everyone out, as already fake as they are out, and then just rip to the upside. I mean, really rip. Now, we need to see some price action in the dollar reflect that. Obviously, Ty, if the dollar continues to rally, man, it's really hard for these dollar-denominated assets to push any type of meaningful advance if the dollar's still ripping higher, right? Inherently speaking, when the dollar rallies, dollar-based assets will tend to move down in value as the value of the dollar moves up. Not always a tit for tat type of move, so not a principle you want to live by, but certainly the dollar strength isn't helping, right? So conventional wisdom would say that you would look for one stab low, like literally maybe just a scratch below the March low day close again, and then a rip higher. But at the end of the day, if we settle a daily close above 1215, in my mind, and especially if we get that with the trigger break, I do think you get a larger recovery. In gold. So this is the daily chart, right? Here's the intraday, Ty. At the end of the day, objective stuff. Here's your weekly open. Here's your objective weekly opening objective weekly opening range highs, basic 2-point resistance triggers, a resistance slope. So I'm not really stressing this. I just have it there as, something to be mindful of. But, it basically just highlights that if we get a break above the weekly open, that's an objective signal in near-term momentum. You start to look for an advance higher, the major, level that would change things. Let me snap these levels for you. There we go. The objective level that would sort of change things. So again, 1215 being that key level, the objective weekly opening range high, 1217. But this is the level that would change things would be like a 1236 break. That's how you know, or that would suggest that a more important low is in. But right now, the focus is on a break of this near-term range. I like the idea of a topside break, Ty. I've been thinking that since we came into this level to begin with early in the month or earlier last month. But it's been a slow grind. It's been a slow grind. The reason I think that is because if you get, like I said, when I see a break of a major key support confluence, especially when you're talking about a multi-year or a multi-month, retracement level, when you see a break of those things, I want to see a drop. I want to see an acceleration. I don't want to see like a mutter lower. So the fact that we're at these lows, the fact that we're at this region, you're getting this triangle consolidation. Yeah, in my opinion, again, just my humble opinion, I would want to see this break to the upside. I would want to see this break to the upside. Dollar and DXY can rally together. The last trip to the highs that happened. Ty, I'm glad that you bring that up, and that's actually a very good point. So as opposed to what I was saying earlier, where yeah, the dollar strength is going to kind of limit the upside in gold, they can rally together. And absolutely, if you put an overlay on a chart in the dollar and gold, guys, there's definitely times and periods in history where they rally together. It depends what the underlying environment is saying, though. The problem is this: that you have a pull and tug of match with gold and the dollar. The problem is increasing better data will tend to help the dollar because that means the Fed is likely to increase or hasten its approach on interest rate hikes in the future. That tends to be bearish for gold. But at the same time, you have these sanctions with Iran that are coming up now. You have, obviously the trade war talks and tariffs that are kind of increasing the threat to markets. So that bid for haven has also been something that's been holding gold up. You can kind of conceptualize just by looking at the market themes and all the headlines that are coming around why you're getting this push and pull with gold over the last couple of weeks. Now, obviously, it's still been a trend to the downside, but boy, it's contentious. It's contentious. 1204 has been our line in the sand. We've been talking about that. The downside break beyond this, there's really nothing until 1180 of consequence. I have a soft target here at 1194, just a former swing low, but that's sort of your next big level. So Ty, to answer your question bluntly, how do we look to approach this trade? Just looking at like price action. It's very simple. It'd be either a break above 1215 and a close above here. You'd look for a pullback into that region to get long against these lows to play the recovery. Or if you break the lows here and you're not in it, so be it. Okay, you let it drift, you come for the pullback, and you look for that last extension down towards the lower parallel, towards those former swing lows from last year. So inside this range, if you want to feel compelled to trade into resistance range highs, trade into resistance range lows or support range lows, that's fine. Not my cup of tea. This thing is coiled up. I think we get it. I think we get it soon. Ty is saying Trump is winning, tariffs and the economy fundamentally solid. I am a DXY bull. It won't pull back, says Ty. You are great, Mike. Cheers, Ty. I'm not going to get into the political arena. I try to stay as neutral and balanced as I can, just for the sake of avoiding drama, Ty. But I mean, hey, it is what it is. I mean, if you look at the markets, yeah, you can't really argue with that statement. How this pans out, and like I said, the whole thing with tariffs is yes, the basic conceptualization of what he's trying to achieve is very, very fundamental to free market trade, as opposed to what the headlines say. But if the skirmish turns out to turn into really a full-on, more of a global trade war in more real terms, then this could end badly for sure. So yeah, that's economics. I'm with you on that, Ty. we'll see how all this pans out. But look, no one's saying the dollar is not a bull, Ty. I just want to make that clear. If we're being objective, the dollar is in an uptrend on a weekly basis. The dollar is in an uptrend. No one argues that. It depends how far you look, though, right? It depends on what time frame you're looking at. This uptrend on the near-term daily chart, yeah, you're coming towards range highs, but even this entire advance is within the confines of a larger decline. You know what I mean? So we have to always keep in concept where we are in trend, and that's the whole purpose of why I do multi time frame analysis. It's time consuming. It could really be a grind sometimes, but that's why I put in the work for you guys, so you don't have to spend all the time to do it. But you see where I'm coming from. We have to stay disciplined, and we have to stay objective. So we're at range resistance within the uptrend. If we clear this 200-week moving average, which has been insane resistance, then yeah, look for resumption. 96 right on up into 97 would give you the upper parallels. That being said, range resistance is range resistance. Everybody's leveraged to exports to US. Their financial systems cannot take big setbacks. They can't service the DXY debt. Ty, that is a whole discussion I can get into, and I love these topics, so we can go all day. But the trade deficit, not the trade deficit, the servicing of U.S. debt is, in my opinion, going to be the next major crisis, I think. And again, it's just my opinion. It's sustainable for now. It's all good and dandy while markets are rallying. The debt is obviously, insane, out of control, but that's not going to come into focus until you see market correction, or you start to see market strains. Then market attention shifts right back to, okay, well, now we just got a tax cut. How are we going to service this extraordinary amount of debt? And especially as interest rates move higher, Ty. The debt servicing at this point has been so minimal because we are at such rock bottom rates, right? But now that the market's starting to, wake up, the economy has picked up, interest rates are starting to move up, servicing that debt is going to be a huge portion of government expenditure, and that's going to be really, I think, going to be the next major problem. China has no room. They're crumbling now. Well, I wouldn't say they're crumbling per se. We've actually got a decent rebound recently, but like Ty, yeah, out of this trade war talks, obviously China has been, on the receiving end, has been the bigger. Just look at the markets. Like I said, S&P is at the highs. China markets have been pretty much taking it on the chin. So we'll see. Try austerity, says Dagon. Ouch. Yeah, that's not going to happen, right? The economy recovery is Main Street, not financial, much less vulnerable. I agree with you on that, Ty, and that's why you'll hear all these guys coming on CNBC, Bloomberg, Reuters, that the underlying economics, the underlying economy is strong, and you can't deny that. Okay, you're starting the laggard, obviously, that the Fed is waiting for is wage inflation. That comes when you get excess, when you get strained capacity on employment market. So obviously, again, like we have now, we have more jobs open than we have employees, and or absent workers. And that actually is when you tend to see wage inflation start to pick up, because you need to attract, more talent, and obviously, keeping your wages competitive is part of that whole process. So yes, the underlying metrics on Main Street seem to be actually improving. But Ty, you're getting me all sidetracked. I can get into this discussion. We should have a webinar just on this, the fundamental topics, right? But I'm going to close it at that, guys. It's 9:30. U.S. markets just coming online. Guys, have a great trading day. Again, patience pays. Stay nimble. These coils are not going to last forever, and when we want to be positioned and have our levels well mapped out. So best of luck trading. Watch the RBNZ later tonight. Kiwi is the one to watch as that thing sits at support. Let's see how that pans out. Dollar CAD is the other one that we're watching on the way up. Is see if this thing fizzles out. Oh, wow. I may have spoken too late. Ooh, that was the entry. Shoot, we just missed it. Well, keep your eyes on this one nonetheless. Okay, we got the reversal where we were looking for. So look for a little bit more larger of a dollar correction here, or a dollar CAD correction near term. All right, guys. Jamie will be up in just over an hour and a half. Best of luck trading. See you tomorrow morning. Cheers.